Hi guys, cool, great. So this is part three of this video. Um, so I think fundamentally we've talked about what happens with trading income and losses and that relationship. With capital gains, there is just a bit more, um, I think, fluidity. We're really just moving assets around. But the starting point, the big point that I want to highlight here, using this example, is what allows us, enables us to be part of um, a gains group. So first of all, you can only have one gains group. So subsidiaries cannot be a parent company of a separate gains group. Key point. Secondly, if you do have sub-subsidiaries, there must be at least a 75% interest in that group, in that next um, in the subsidiary. There must be at least a 75. So maybe that's the bit sometimes people forget. It's so easy to forget because you think, oh, because you see ultimately the parent has to have an effective 50% interest. So the argument becomes, well, if the parent has to have, so people think, oh well, I can see an effective 50% interest, I'm done. No. There must still be at least a 75% interest. That's the first rule you have to kind of remember. So here everyone's happy because at least it's 75, 75, 75. That's ticked. The question here is, does Organ, I'd probably go with Organ. Does Organ have a 50% interest in Dents? I don't think it does. I think it's about 42.5. How do I know? 75 times 75 times 75, if you like, 0.0.0 takes us all the way down to about 0.425 or something along those lines. So Dents can't be part of this group. So Dents can't pass through its capital gains and losses or any assets between to take advantage of this, group relief. Right, and we're dealing with a company here. So this idea of company brings into context this idea of inflation. So we account for inflation up to, there's a restriction up to December 2017. So all inflation is happening up till December 2017. So you need to kind of remember that. So what does that mean? So typically assets are transferred. I mean, it's just like moving it from one department to the next within the group at no gain, no loss. And we can roll over on a group basis. And we'll discuss this idea of rolling over. So in effect, recalculating the base of a new asset when we spend the money. But anyway, let's see. So the key point here is that we're not really interested in what actually, if you bought and sold it within the group, that's just intra. Those are intra-group transactions which get eliminated anyway. Those transactions get eliminated anyway on trade. But what we can do, what we do see, is that we must index and we must account for inflation. We must account for inflation. That's the key thing that we have to do. Right. So where are we? So until the person sells it outside the group. So we're literally, again, really accounting for inflation. That's what's really happening here, accounting for inflation. So let's see here what's going on. December 2017 is the key date to take into account. So let's see what's happening here. So really what's happened here ultimately is, this says on the 15th of December, a property was transferred from Goodman to Arlene for 300,000 when his market value was this. The truth is, both these figures are entirely irrelevant. Really, we're just interested. We're just moving the good or the property, from one statement of financial position to another, which is what we would have done anyway, even in just normal corporate reporting. Right. So it costs. So let's just we just want to understand what's going on with this. So here we are. Goodman picked this thing up for 53,000. March 99, and it gave it to Arlene on the 15th of December. So here we are, 15th of December. So this is my indexation calculation. Ultimately, this is by how much the price has risen due to just pure inflation. And that's what I want to account for, because it's unfair, right? They just be taxing inflation. because when I come to sell it, if you don't account for this, you'll just have this gain. That's just inflation, and that's not really fair. So what we now have is, if you like, the new base cost, so to speak, in December 2017, I believe it is. Did they give it to them? I think it was 17, not 7. Oh, 2007. So it was transferred 2007, forgive me, not 17. So transferred 2007, that's the inflation, 0.285. So what do I simply do? Calculate, do the 55,000 times 0.285. And that takes us to, again, this is just inflation. So you might, I'll probably go through a number of ways that you could think about this. 55,000 times 0.285 takes us to, that's the inflation there, 15,675. So you can add that on, of course, to the 55,000 plus 55,000 takes us to 70,675. That's the new cost at the 31st of December 2007. Then it says that you sell this thing in September 2008. So you can see here from December 2007 to December 2017, this is what I'm interested in. The inflation from here to here is 0.319. So that's the cost now at December 07, 7675. Inflate, indexation allowance, so 0.319 times 7675 times 0.319, and that's 22545. 22545 plus 7675, 76 takes us to 93,220. Because again, all indexation stops according to the new standards and the new rules in December 2017, and that's my new cost. So when I come to sell this thing, it says that you sold this thing for, I believe, 800,000. Yes, so you sold it for 800,000. So you have 800,000 proceeds. Now I can dispose of it. Cost, or index cost, 93,220. 800,000 gives me a chargeable gain of 706,779, or 7,067, or 780 if you like. Probably 780 actually. When I think about it, 780. And that's how we deal with it. I mean, you could have, again, it's just inflation. They give you a number of issues there. You could have gone from here. You could have literally multiplied. You could have gone from March here to here. You could literally have inflated this 53,000 by this figure times 0.695, if you like, and that would have gotten you your inflation, or 53,000 times 1.695, and that would have taken you to your final cost, right? Because that's all inflation is, just that added on top of that. Okay, great. So that's that. And so the companies within a gains group can make an election to, if you like, between group companies. We sort of agreed that already. That's the whole point, that we can share gains and losses. 2-year sort of allowance. This will pick up as we do some questions. And this allows us to then match it with companies and with gains and losses in different years. But let's see a question just to kind of highlight what's going on here, because this is the last question in this batch. We'll do it in here as well. So what do we have here? It says that Violet disposed of a factory, which resulted in a capital loss of 75. So Violet disposed of a factory, capital loss 75,000. So that's a loss. Now, like I said, remember that she can't use this capital loss against her trading profits. No, it just holds. Okay, great. So you now have Maeve, who has a chargeable gain of 100,000. So whether or not Violet gives the factory to Maeve or gives the loss to Maeve is really irrelevant. The key point is the net effect is what can she do with it? So this happens in her year. The only taxable income is trading income for Maeve. Maeve has trading income of 30,000 and Violet has 250,000. Maeve cannot use this 75,000 against the trading income, unfortunately. Doesn't work like that for companies. What she can do is she can give this trading loss to Maeve, this capital loss to Maeve. Maeve can then use this capital loss as though it was hers against her profits, capital gains, forgive me, of 100,000, giving her net capital gains of 25,000. So now basically her schedule will look like this: trading income 30,000, capital gains 25,000. All of this will get taxed at 19%, right? Because corporation tax is applied. Corporation tax is applied to all gains. Yes, and that's kind of how we would deal with this. Yes, and then so Maeve would just have to deal with this. Violet will have to deal with the 250,000, if you like, at 19%, because there's nothing to offset, if you like, because this is all gain. This is all trading income, isn't it? It's just tough. Right. So let's look at this. So that's the first bit. Yes, and that's how we deal with this transfer of capital loss. So it says here, explain how your answer would differ if the loss made by Violet had actually been made in the previous accounting period. So what we have here is that Violet has made this loss of 75,000 in this period, if you like, in the 18 period, and Maeve has a gain of 100,000. So really, what would happen here is that Violet cannot transfer the loss to Maeve, as they are made in different periods. But like I said, this really doesn't matter, because all Maeve has to do, because Violet can't transfer the loss to Maeve because they are in different periods, well, all Maeve would do is to give the asset to Violet. So if Maeve gives the asset to Violet, Maeve now has a gain of 100. Sorry, Violet now has an asset with 100,000 gain, and she literally brings forward, if you like, that loss against that asset, because the asset is hers, and she can use capital losses against capital gains within her own books. So Maeve has to give Violet the asset so that Violet can then use the loss against the asset, because it's now hers and she's made a gain. So she can bring forward the loss, but only against assets in her own books. But she can't just transfer the loss. Because they were different periods. And that's how we really deal with that ultimately. Right. Great. So what we now have here is this question of group rollover relief. We'll see this a bit of this as we carry on, but really the key point here is that if you sell an asset, a qualifying asset, and you make a gain, we can defer that gain. We can defer that gain. And how do we do that? As long as you reinvest in another qualifying asset within a 4-year kind of window, you can defer. As long as you reinvest that money that you made from the first asset, that will determine the extent to which you can defer that gain. But you're only deferring that gain in the base cost of the new asset you're buying. So hopefully, as we see questions, when we start working on capital gains, as we will, and special rules and things like that, we'll see all the different examples of this. But again, really, ultimately, just give the asset to the company that needs it, and then deal with the rollover relief within that scenario. Cool. That brings us nicely again up to 15 minutes, and that's the end of that chapter. Cool. See you in some more capital gains questions.